So, what is the Augusta Rule and how does it work?
The Augusta Rule. So I'm in Atlanta, Georgia, and the Augusta Rule comes from Augusta, Georgia, which is about 2 hours that way, actually. In Augusta, Georgia, there is the Masters Golf Tournament every year, and this is one of my favorite backstories. In the Revenue Act of 1976, there was a little provision that was slipped into the legislation that is still there today. It's 280 AG2, which is the Internal Revenue Code section. And what it says is that anybody can rent out their primary dwelling for up to 14 days, and whatever revenue you have from there is excludable from your taxable income. And similarly, 280 AG1 says that expenses from that are not deductible. Basically, if you have a primary dwelling and you rent it out for up to 14 times a year, if you go 15, you're breaking the rule. But 14 times or less, then that revenue that you get from that rental activity is not part of your taxable income. So it's just excluded. Okay, so the what this originated from was there was a bunch of rich guys who live around this fancy golf course, and during the tournament, they wanted to rent out their properties and not pay taxes on it. So they lobbied Congress, and they got this code, put into the legislation. And I've actually looked up the legislative notes. So I was born in 1980, so I wasn't around for the Revenue Act of 76. But if you look at the legislative notes, it talks about the committee hearings that have and how the bill has changed over the committee hearings and same kind of stuff that goes on today. And if you look one day it's not there and the next day it's there and there is no discussion about it. so this was just slipped in there and is still there 50 years later. So it ended up being called the Augusta Rule or the Masters Rule or whatever because of that connection. And every year, if you look at the Augusta newspaper, which is I think the Augusta Standard, I think it's what it is, they'll run an article every summer around the tournament that says, so and so is saving however many thousands of dollars in taxes by using the Augusta Rule, which is kind of funny. So that's what it is. Now you can supercharge this if you have a taxable or if you have a company that's a distinct taxable entity. So this does not work for Schedule C companies, does work for other things like S corps and partnerships and things. So the way to supercharge it is that you have your company rent your primary dwelling from you for up to 14 times a year. Now, here's where people screwed up. People screwed up because they picked the wrong number. They'll say, "Oh, it's rent is $10,000 a day." It's like, well, okay, based on what, right? And there have been court cases where numbers have gotten thrown out because they just didn't have any documentation or didn't have any reason for the rent they were charging. And the other thing is that for any business deduction, there has to be a purpose behind it. So, what is the business purpose for this rental, right? And the way we help with that is that, well, one, we do market research and we figure out what's an actual number based on actual listings in your actual place so that we can get an actual justifiable amount to deduct. And the numbers can be decently significant depending on where you live. I remember I think it was 2 years ago we actually saw rental numbers go down, and we had clients emailing us to say, hey, this is less than last year. I was like, yeah, just because that's the market. Rentals had gone down that year. So anyway, um, that's number one. And then number two is for the business purpose. For why does the business need to rent this place from you